Welcome to this lecture video. In this lecture video, we are going to look at foreign subsidiary. Sometimes the subsidiary that the parent acquires is in another country and perhaps might be preparing their financial statement in their home presentation currency. But it is important to consolidate the foreign subsidiary using the treasury currency or the currency of the group. The process of consolidating a foreign subsidiary is pinned on IAS 21, accounting for foreign exchange rate. So the principles that we use in the conversion of a foreign subsidiary are all in IAS 21. So before you listen to this lecture video, it will be important if you revise the IAS 21 lecture video. When you want to consolidate a foreign subsidiary, we will go through the 5-step approach in doing our normal consolidation. We will look at our group structure, which will look at the percentage of ownership in the foreign subsidiary and NCI in the foreign subsidiary, and the date of control, just like we know how to do it in previous studies. Then we will look at our workings 2. Now, workings 2, we will determine the net asset of the foreign subsidiary, just like we already know how to do already. But the issue here is when we are determining the net asset of the foreign subsidiary, we will use or we will determine it in the currency of the foreign subsidiary. So we will determine this in the currency of the foreign subsidiary. So assuming the foreign subsidiary has a currency of dollars, that means we will present our workings 2 in dollars. So the procedure or the process of presenting workings 2 has not changed. So we will not waste our time looking at how to determine foreign net asset of the subsidiary. No, we don't have that time to determine the net asset of the foreign subsidiary. No, we are just trying to tell that it's the same thing, just that the currency will be using will be the foreign currency. So in case you have any of these figures that you use in your workings 2 being in the domestic currency or the parent currency, you have to convert it to the currency of the subsidiary. Then we'll do workings 2. So we will separate it. So we have workings 2A, we'll present it in the currency of the foreign subsidiary. Then our workings 2B, whatever we have computed in our workings 2A, we will translate it to the parent currency, and any forex gain or loss on translation will be shared among the owners of the subsidiary. Workings 3, which is goodwill, we also determine the goodwill just like you know how to determine it, but also determine it in the foreign currency. Then we will translate the goodwill, right? We'll translate the goodwill to the parent or group's currency. Our NCI in the foreign currency in the foreign subsidiary will be determined at the parent using the parent currency. Then our group retained earning obviously will use the parent currency. So the only new thing that comes in is the working 2B and workings 3B, and also telling you that the workings 2A, where is the net asset acquired of the foreign subsidiary, will be determined in the foreign currency, and the goodwill will also be determined in the foreign currency. Then we will translate our net assets into the presentation currency or the group currency, and also translate the goodwill into the presentation currency or the group currency. So let's look at how that translation will be done. Right, so from IAS 21, this concept is coming from IAS 21. For assets, liabilities, and equity, we will use the spot rate to do the translation. Meaning, if we have assets, liabilities at close, we will use the closing spot rate to do the translation. And for assets, liabilities, equities at opening date, we use the opening spot rate to translate it. Meaning, if you have any assets, liabilities, equity at the acquisition date, then we'll use the what spot rate at the acquisition date to do the translation. Right, it's a very easy concept in IAS 21, saying that for assets, liabilities, equities, we use the spot rate to do the translation. So looking at the date, you will use the what spot rate at that date to do the translation of assets, equities, and liabilities. It's no big deal. There's no difficulty or challenge with this. For assets, equity, liabilities, we use the spot rate. So if the assets at closing date, we use the closing spot rate. If the assets at the opening date, we use the opening spot rate. If the assets are being determined at the acquisition date, we will use the spot rate at the acquisition rate date. Simple and easy. Then for profit or loss items, let's get the highlighter, the pointer. So for profit or loss items, we will use the what average rate. So for profit or loss item, revenue, cost of sales, post-acquisition profit, impairment, these are profit or loss items. We will use the average rate because sometimes it is difficult determining the spot rate for all profit or loss items. Hence, for making things easy, we will use the average rate. So note that if the acquisition date is not the same as the opening date, the examiner will give you the exchange rate at the acquisition date. This rate will be used to translate assets, liabilities, and equity at the acquisition date. Right? As I've already explained earlier. Now let's look at how to do the workings 2B and the workings 3B. Because workings 2, workings 3, workings 1, workings 4, and workings 5, we are not going to spend time even looking at it because you should be able to do those workings as at this stage. So you would have already, so this is how we do this. This is the format. So we have the workings 2. A is for the net asset, right, of the foreign subsidiary. So this would have been the, let's assume that the foreign currency is pound sterling and the home currency is dollars as cross. So when you pick your workings 2, when your workings 2A is, you look at your net asset as at the acquisition date, right, plus the post-acquisition profit gives you the net asset as at the reporting date. Probably your mind has not gone there. Let me refresh your memory a little. See, when we have the net asset as at the acquisition date, you know, when we add the PAP, when you add the PAP, then you get the net asset at what? At reporting. Do you understand? So when you have a net asset as at the acquisition date, and you add the PAP or you deduct the post-acquisition loss, then you have the net asset as at the what? Reporting date. There's no need to go and list all the equity items at opening and all the equity items at closing. No, it's not necessary. So we add it. So the total net asset as at the reporting date plus the post-acquisition profit or minus the post-acquisition loss will give you the total net asset as at the what? The reporting date. So this is the total net asset as at acquisition date, right? That is it, the total net asset as at acquisition date. And it's in the what? And there's a foreign currency, that's pounds. Then plus post-acquisition profit. So if there's any post-acquisition profit, then plus post-acquisition profit. There was any post-acquisition loss, then you deduct it from the opening net asset. Then when you deduct, let's say if this one was, let's say 400, and let's say this one was 100, we should know that the expected net asset after the reporting is going to be 500 pounds, right? 500 pounds. So the actual net profit after the reporting date, because there's not is the same currency, will be 500 pounds, right? But if we should translate, so we are going to do the translation. So we look at the rate of what? Rate of exchange that you use. So if it is opening net asset, you use the what? The opening spot rate. use the opening or spot rate, right? But if the opening spot rate is not given because it's a media acquisition, then you have to use the spot rate at the acquisition date, right? You have to use the spot rate at the acquisition date, right? Very good. So you translate this 400 into the home currency. So you have a rate here that you use the rate as at the opening. Don't use the opening opening rate, right? To translate it. Let's assume that the translation is, let's say, 350. Then you look at the post-acquisition profit or loss. It's a P&L item. So what do you use? We use the average rate, right, to translate. So let's say when we translated, we had, let's say, 80. Mm, you had 80, right? So if you have 80, the 350 plus 80, that gives us the expected what? The expected net asset as at the reporting what date, right? So uh, 350 plus 80 gives us 430. Yeah, 430. So assuming if we translate we will translate this closing net asset using the closing rate, and let's say we get 490, because you can see that the expected is 430 and the actual is 490, and because it's an asset, right? Because it's an asset, is it a gain or a loss? It's what? A gain, because obviously we are expecting 430 and we get 490. That means there's a gain in the translation of assets by what? Yes, by 60. Okay. You can say this gain of 60 is will be already be in the what? In the home currency or the group's currency. So there's no need to do any translation again. That'll be okay. Very good. Right, so very good. So this 60 is coming as a result of translation of which company's asset? The subsidiaries company's asset. So the 60 is like a gain, right, from translating or remeasuring the subsidiaries what asset. So the gain of 60 becomes what? Becomes a profit or a loss, or it becomes a gain that should be shared amongst the owners of the subsidiary, right? So when you go to reference one and you look at the group structure, you look at the effective percentage, and you share the 60 among the parent and the NCI and the foreign subsidiary. Hope we are clear on that. Very good. But assuming the actual uh, translation of the 500 using the closing rate was, let's say, 410, it means that we're expecting 430 here, but the actual is what? 410. That means there is a fall in value of an asset, right, by 20. And that becomes what? Forex exchange what? Loss, right? Forex exchange loss. So you just share the forex exchange loss or forex exchange gain amongst the parent and what? NCI. For the NCI share of this forex gain or forex loss, it goes to against 4. But for the parent share of this profit or loss on translation of the net asset of the subsidiary, this parent share of the forex gain or loss does not go to Workings 5. It goes to Workings what 6, and that is the group forex reserve account. So you keep it in the group forex reserve account. So that's it at the bottom there, the group forex what reserve what account. Because the retained earnings serve as an account that we put realized or realizable what earnings into those accounts. So if the account has a nature of other comprehensive income or other components of equity, it is important to separate it from the group retained earnings. Okay. Now look at goodwill. It's the same thing, right? So we have goodwill. The only thing that will let goodwill change over a period is what? The impairment, right? So we translate the opening goodwill to the home currency. You translate the impairment to the home currency, right? But we know that when we add the opening goodwill and deduct the impairment from the goodwill in the foreign currency, we are expected to get some value as we can use, let's say, 200, and let's say 20. So we are expected to get 180, right? It's the same thing, so we'll get the same 180. But we translate this 200 into, let's say, 150, and the 20 we translated it to 10, right? That means we'll be expecting what? 140. So if in actual sense our goodwill was, let's say, 130, that means there's a forex what? A translation loss of what? 10, and to be shared between the parent and the NCI and the foreign subsidiary. Note that the parent share of the translation gain or loss on goodwill or net assets of the foreign subsidiary will be taken to the group forex reserve. That's it for the parent share of it. But the NCI share will go to workings for. Will go to workings for. Okay, that's good. So that's it for foreign subsidiary. There's no big deal. Right, so we have our 6 standard workings, just that we have to include workings 2B and workings 3B. Workings 2B looks at the translation of the net assets of the foreign subsidiary, and workings 3B looks at the translation of what goodwill. But please note that workings 4, that is the non-controlling interest, and workings 5, that's the group retained earnings, will all be determined in the home currency. Will be determined in the home currency. Will be determined in the home currency. Okay. All right. So that's it. Thank you very much. We will look at a question on foreign subsidiary in our next lecture video. All right. So thank you. See you then. Bye bye.